You probably know this guy. He is Kevin O'Leary, a business guru, entrepreneur, investor, celebrity, and a self-proclaimed financial expert, or depending on who you ask, a greedy opportunist, a liar, a manipulator, a bully, and a self-obsessed piece of work. O'Leary isn't just another businessman. He is a best-selling author and one of the infamous sharks on Shark Tank. On the show, he's known for his razor-sharp tongue and a complete lack of mercy for struggling entrepreneurs.
You are. You've got a real business, but you're a pig. You're greedy. You're not leaving anything for me to wet my beak with.
He may look like an old grumpy grandpa on the outside, but deep down there's a much serious side of him that makes him willing to do anything for money. Even if it means taking U-turns, manipulating people, or throwing his own followers under the bus. And this isn't just an opinion, his past proves it. Take crypto for example. Back in 2019, when Bitcoin and other cryptocurrencies were gaining attention, O'Leary hated them. He even went on TV and called crypto garbage.
Try and do a transaction over $100,000 with Bitcoin. I tried to do some real estate in Switzerland with it once. It is a useless currency. It is a useless currency. That's what I believe. I mean, look, I'm not, I realize people have different opinions, but to me, it's garbage.
But just 2 years later, he was suddenly calling crypto the future of investing.
You were so negative for a while and just definitive, like you always are. You may know nothing, but you're never in doubt, but you were so negative. Then you got totally positive. Do you own Bitcoin now? Kevin, what's your position in crypto right now? You do.
Look, Bitcoin is not a coin, Joe. It's simply software. Ethereum is software. If you own, HBAR software, if you own Microsoft, if you own Google, why don't you own Bitcoin? It's all software.
So what happened? How did he go from openly mocking crypto to becoming one of its loudest cheerleaders? Well, it turns out that Mr. Wonderful signed a $15 million deal with FTX to be its official spokesperson. And that was the reason for his sudden love affair with crypto. After finalizing the deal with FTX, he went on TV, podcasts, and interviews explaining the benefits of investing in crypto while hyping up FTX as the go-to platform for investors. He also spoke highly of Sam Bankman-Fried, calling him a savant and praising his brilliance. But then, just a year later, FTX collapsed, turning out to be the biggest financial fraud of the decade. And guess who was caught right in the middle? Mr. Wonderful himself. Now when FTX's house of cards crumbled, you'd think O'Leary would immediately cut ties, admit he made a mistake, or maybe even apologize. But no, instead he kept defending FTX and tried to shift the blame onto Binance, FTX's biggest rival. Even during the lawsuit hearings, he continued painting Sam as a victim.
Binance is a massive, unregulated global monopoly now. They put FTX out of business.
Now, if you're wondering, why was he still defending FTX and Sam when it was clear that there was no coming back for them? Well, it's because he had no other option. If he admitted that he had no idea FTX was a scam when he made the deal, it would prove that he saw the big fat check and didn't bother to do due diligence, which may shatter his carefully crafted image as a financial expert. But if he admitted that he did know the reality of FTX and still promoted it, the consequences would be even worse. So he chose to keep defending FTX rather than accept his mistake. But when it became clear that FTX was beyond saving, O'Leary's stance shifted from defending FTX to defending himself. He went on a media tour, claiming that while he was paid $15 million, he had to pay taxes, sponsorship agents, and conveniently deposited the rest into FTX, meaning he lost it all when the exchange collapsed. He used this to pin himself as a victim. But here's the problem. His story kept changing. In one interview, he said he was paid $15 million.
Not a single dollar that I lost is anybody else's money except mine. That's important for me because that's an issue.
How much were you paid?
Total deal was just under $15 million, all in.
In another, it was $18 million.
Everybody's asking you about, your endorsement of FTX, the $15 million bag, but nobody's asking you, how you doing? How are you feeling?
Well, let's just get the numbers right. It was $18 million.
18.
Okay.
Now this makes it really hard to believe that whatever he's saying is even true. And honestly, it doesn't even matter, because this wasn't the first time Kevin O'Leary found himself in the spotlight for all the wrong reasons. In fact, if you dig into his past, you'll find that his entire career has been built on unethical, manipulative, and ruthless business practices, along with an unshakable willingness to do whatever it takes to make a quick buck. And all this started right after his first big breakthrough. O'Leary graduated from University of Western Ontario in 1980. After that, he co-founded a small television production company that focused on low-budget sports programming. But the venture struggled, so he decided to sell his shares to one of the co-founders. With his hands freed from the TV company, O'Leary set out in search of his next big business opportunity. During that time, the personal computer market was exploding. More and more households were buying computers, and this was the pre-internet era, meaning software couldn't be downloaded online as we do today. Instead, software programs in those times used to come loaded in compact discs. So if you wanted a program like Excel, PowerPoint, or the latest video games, you had to buy a compact disc loaded with the software. O'Leary saw this as a business opportunity and started SoftKey, a software production company that didn't make softwares, but rather bought the rights from developers, packaged them into compact discs, and sold them to general population. Initially, SoftKey focused on a variety of consumer software, from spreadsheets to grammar checkers, selling them in small computer shops. But as the number of personal computers skyrocketed, so did the demand for software, and SoftKey's discs started appearing on the shelves of major retailers like Office Depot, Radio Shack, and Kmart. By the early 1990s, personal computers had become common, but they were still basic machines primarily used for simple tasks. As a result, most people were reluctant to invest in expensive software programs. O'Leary saw this trend and came up with a simple strategy: quantity over quality. SoftKey focused on producing simple, budget-friendly software, selling some programs for as little as $5 per copy. At its peak, the company was releasing 10, sometimes even 20 new programs in a month. While these programs were often low in quality, they were affordable and got the job done. This strategy worked so well that SoftKey became the fastest growing company in Canada in 1992, boasting sales of $36.8 million and a profit of $6.1 million. O'Leary seemed to have found the golden formula, but then the internet happened. In 1993, the World Wide Web became public, and within 2 years, internet users grew from 14 million to 44 million. This became a nightmare for SoftKey because now people were able to download software straight from the internet, often at a fraction of the price, as there was no cost of physical packaging or margin for retailers. Suddenly, customers were only willing to pay for physical discs that contained high-quality software. If they wanted something cheap, they could just grab it online. So selling low-quality junk at big retail stores became an unviable option for SoftKey, a strategy they had used from the beginning. SoftKey wasn't able to produce high-quality software because of O'Leary's reluctance to invest in research and development. The company wasn't improving its products, and without innovation, its software quickly became outdated, their games got stale, and they couldn't compete with prices on the internet. As a result, consumers stopped buying their discs, which affected the company's balance sheet. Soon, SoftKey's financials started bleeding red. And O'Leary was smart enough to realize that he had to act quick or the company will collapse. So he decided to take SoftKey public. On paper, the company looked impressive, with $110 million in revenue, but also $57 million in losses. To keep the company afloat, O'Leary resorted to another, more ruthless strategy, that is buying other companies. Throughout the 1990s, SoftKey went on a shopping spree, buying up over 10 different companies. O'Leary's playbook was simple: strip these companies for cash by laying off employees and slashing development budgets. This created short-term profits, but in the long run, sales always collapsed due to lack of innovation. SoftKey's biggest acquisition was the Learning Company, which they acquired for over $600 million. The Learning Company was the largest educational software company in the world at the time, holding an impressive 16% market share. They made educational games aimed at elementary school students. In 1995, O'Leary proposed to buy them, but the Learning Company's management did not want to sell. They were skeptical of SoftKey's aggressive tactics and feared that the acquisition would spell disaster. And they were right. Before finalizing the deal, the Learning Company hired forensic accountants to examine SoftKey's finances, and what they found was troubling. They found that SoftKey was inflating its earnings by hiding several costs as write-offs. Its audit committee was also questionable, with O'Leary himself as a member, alongside a board member linked to past financial scandals and a paid consultant. Despite all these red flags, O'Leary pushed the sale through. After acquiring the learning company, he rebranded SoftKey under TLC's name. But instead of improving the business, he continued his ruthless tactics of firing employees and slashing development budgets. Also, the company kept swallowing up smaller businesses. And while this temporarily boosted revenue past $800 million, behind the scenes things were falling apart. An SEC filing revealed that in 1996, the learning company reported $376 million in losses. In 1997, that number grew to $495 million, and by 1998, their accumulated debt had hit a staggering $1.1 billion. At this point, the company was in free fall. O'Leary and his partners knew they were sitting on a ticking time bomb and were desperately looking for a way out. Luckily for them, they found one. In 1998, Mattel, a toy giant known for brands like Barbie and Hot Wheels, made an offer to acquire the learning company. Mattel's strategy was to integrate its valuable intellectual properties into the learning company's video games, aiming to gain an edge in the increasingly competitive edutainment market. They were so confident in their plan that they didn't conduct thorough due diligence or even basic market research. Everyone in the software industry knew the company couldn't survive for long, yet nothing could stop Mattel from making this deal. They acquired the learning company for over $4 billion, and O'Leary became the president of Mattel's new digital division. Mattel was expecting a profit of $50 million from this acquisition, but instead, both revenue and profitability started declining almost immediately after the deal was closed. The company was reportedly losing $1 million for Mattel every single day. In the first quarter, Mattel lost $105 million. By the next quarter, losses climbed to over $200 million. And over the next 2 years, Mattel's stock price plummeted by 70%, erasing nearly all the gains it had made over the previous decade. Initially, Mattel's management was unable to figure out the problem, but later they discovered that the learning company had been cooking the books. They would sell products at the end of the quarter and record them as revenue, even though most of the merchandise would ultimately be returned. By the time Mattel realized the extent of deception, it was too late. Investors filed lawsuits against Mattel over this disastrous acquisition. They also found that O'Leary had sold his Mattel shares right at their peak for almost $6 million. This led to him being fired just 6 months into a 3-year contract. The acquisition had become such a catastrophic failure that in 2000, Mattel sold the learning company for just $27 million, a jaw-dropping 133 times less than what they had originally paid. While Mattel's investors suffered massive losses, O'Leary walked away with $11.2 million between his severance package and stock sales. This was the first major glimpse into the persona of Kevin O'Leary, the man who preaches financial wisdom today but left behind one of the most infamous corporate disasters of the 90s. After getting canned by Mattel, O'Leary's business career stumbled and sputtered. But ironically, that $4 billion deal, which was a disaster for Mattel, actually worked in his favor. He had become a well-known name, not necessarily for the right reasons, but as they say, any publicity is good publicity. His newfound fame landed him a spot on Business News Network as a co-host of Squeeze Play, a daily business show. And you could say this was the beginning of his transformation into Kevin O'Leary, aka Mr. Wonderful, we all know today. During his time on Squeeze Play, O'Leary proved that he was capable of drawing a crowd, and he also became quite well known in the media industry. So when CBC launched Dragon's Den, a Canadian forerunner of Shark Tank, O'Leary seemed like the perfect fit due to his entrepreneurial background and his way of handling people. He landed a seat on the show as one of the original dragons, and the show exploded in popularity, pulling in nearly 2 million viewers per episode, a massive number considering Canada's total population was only around 32 million at the time. O'Leary's brutal honesty and tough love persona made him the show's standout investor, and in true Kevin O'Leary fashion, he saw his rising fame as an opportunity to cash in. He launched a mutual funds business called O'Leary Funds, branding it with a unique promise that he wouldn't grind the capital, meaning unlike other funds, he wouldn't use investors' own principal to pay them dividends, a bold claim that made his funds unique and stand out from the others. But there was a problem. Kevin O'Leary had zero background in finance. In fact, he had previously criticized mutual funds on TV. But thanks to his carefully crafted image as a genius investor, people ignored the red flags and poured their money in. Within a few years, O'Leary funds had skyrocketed to $1.2 billion in assets under management. However, cracks soon started to appear. Financial analysts began questioning whether O'Leary was actually keeping his promise. Turns out he wasn't. Some experts discovered that he was indeed grinding the capital, exactly what he had promised not to do. Also, the funds were not performing as expected, so investors started pulling their money out, and the fund's assets began to bleed. Over time, it shrank from $1.2 billion to just $800 million, eventually forcing O'Leary to sell his entire business to Canoe Financial. But despite the fund's poor performance, O'Leary still made good money in management fees. Because at the end of the day, that's how these things work. The investors might lose, but the fund managers always win. Now, O'Leary wasn't just relying on his funds to build his empire. His success on Dragon's Den opened the door to Shark Tank when it launched in 2009. For a while, he juggled both shows, but in 2014, he left Dragon's Den to focus entirely on Shark Tank. And that's where he truly cemented his legacy as the ruthless, sharp-tongued investor we all recognize today. With his brand stronger than ever, Kevin O'Leary kept the money trail rolling through new ventures, endorsements, and of course questionable deals. His involvement with FTX is just another chapter in a long history of controversy, a disaster that once again highlights a recurring pattern in his career: bold promises, questionable ethics, and a whole lot of money changing hands. When you step back and look at the full picture, it becomes painfully obvious. Guys like O'Leary see the average person as a fool to be milked. He doesn't miss an opportunity to rub our gullibility in our faces. So what does this tell us about Kevin O'Leary? Well, if you strip away the TV glamour and the polished persona, you're left with something far less admirable. In fact, he is the textbook definition of a master opportunist. By definition, an opportunist is someone who takes advantage of situations, sometimes at the expense of others, to benefit financially. And O'Leary fits that description like a glove. Whether it's pumping up failing businesses, cashing in on dubious financial ventures, or lending his face to shady schemes, one thing remains constant. He's always got his hands in someone's pocket. Honestly, at this point, if you offered him a stack of cash to endorse literal garbage, he'd probably slap his name on it and call it an investment opportunity. And the saddest part is, people still buy into it. Despite the endless scandals, lawsuits, and clear evidence of his shady tactics, he continues to be idolized as a financial guru. It begs the question, why do people keep falling for these con artists even when the truth is right in front of them? Maybe it's the allure of wealth, the fantasy that if we follow their advice, we can be just like them. Or maybe, just maybe, it's because people like O'Leary have mastered the art of deception, making us believe that they are the winners and we are just lucky to be in their presence. But at the end of the day, one thing is for sure: Kevin O'Leary isn't Mr. Wonderful. He is just Mr. Opportunist.